Hey everybody, it's Mike from Orderflows, and welcome to today's video. Today is Wednesday, January 11th, 2023. What I'll be talking about today is, sort of slower moving markets. What sort of chart types make it easier to read the order flow? Okay, because not every market moves freely, up and down the way MES or ES, especially Nasdaq or most markets. So there are markets out there that move slower, and using a time-based chart on slower moving markets is probably not in your best interest if you're looking at order flow. So, if you haven't already, be sure to subscribe to the channel. And, if you find at the end you get some value out of this video, be sure to like the video. It helps in the grand scheme of the YouTube algorithm. All right, so slower moving markets, right? I mean, we're all familiar with markets, the E-minis where, you're getting 4 or 5 point ranges, 20 ticks, etc. But, on slower moving markets, for example, some of these interest rates, right? The US 10-year note trades, it's very difficult to trade on a time-based chart. This is a 5-minute chart, okay? 5 minutes. So one bar is 5 minutes. And what you're seeing is basically, in this, for this basically 11:45 to 12, you're basically trading the bid offer. Sometimes you trade a little bit above, sometimes you trade a little bit below. But for a half hour, more or less, you're stuck in this area of trading, the bid and the offer, the bid and the offer. And, well, all markets trade with a bid and offer, but I'm saying it is literally not moving. It is, trading 8.5. Sometimes it goes 8.5 bid at 9, trades some 9s. Sometimes it goes 8 offer right here. You can see it trades 2 at 7.5, but more or less it's trading 8.5 for about a half hour. And it's tough, right? It's tough to really get a good handle on what's happening in the order flow when all you're doing is trading the bid and the offer. And sometimes it can be misleading because you're getting these, what looks like imbalances. I mean, these are imbalances, but just because it's just trading back and forth more or less at 8.5 for 20 minutes. So yeah, you have an imbalance, 455 against 4101, 143 against 3815, 259 against 2859. Then you got a buying imbalance here, 147 against 2638. And that's just because we're literally trading one price that whole time. Now, there are days where 10 years do have some very good price movements directionally, on flow-driven markets, on days where there's a big number. Obviously, today was Wednesday. Tomorrow, I believe Thursday, we've got CPI coming out. So, you kind of expect it to be a little bit slow in anticipation of that number. But once that number comes out, you watch what's going to happen to the 10 years. It's going to be moving. You're going to think you're looking at the E-mini chart. And this is on a 5-minute chart. So imagine if you're looking at a 1-minute chart, just for that time period around, 11:50 to 12 o'clock today, it's like watching paint dry, more or less, same thing. It's just hanging around there. And you're really not going to have much to go off of because you're not really trading. You're not moving. Really, order flow really helps you in determining the momentum in the market, right? But if it's a market that just, 10 years it's a unique market because the size is huge. Bid offers usually for thousands, and behind it there's thousands in the order book. But once they start moving, you'll pay attention. So it's what I've learned, over the years. I've traded a lot of grain markets that also can move slow, especially at certain times of the year. There's times of the year corn trades like this. I'll look for things in the delta. What's delta telling me? I'll look at the imbalances, because really what you're looking for is any pulse in the market. Okay, like is things picking up or not? Okay, and sometimes it's just a big order going through. Okay, it's easy to get all excited about something. Oh my gosh, we got stack selling imbalance here, right? 1, 2, 3, and be thinking, oh, this is it. Market's going to sell off, and then it just dies on you. Okay, so you sort of got to understand, right? You want to see some follow through in the order flow as well, not just a big order going through, because moves that happen, legitimate moves, sort of trending moves, you are going to see that uptick take place, but then you're going to see follow through trading. Again, this on a 1-minute chart, it's really hard to get any information just because this market's not really, it's moving bid offer a little higher, bid offer a little bit higher. That's why I've always used a range-based chart when I'm looking at 10 years, 30 years, 5 years. I don't look at twos. Twos really would hardly move. I haven't looked at them in a long time. But if you're looking at a range-based chart, it really becomes a lot easier. You really got to be a bit experienced in the order flow to really understand what you're looking at and get something out of a time-based chart in a market like treasuries. So go to a range. You could use 3, 4, 5. You're not going to use an 8, 9, 10 range chart in the treasuries. 3 is about as minimum as I would go. For many years, for about 8 years, I used a 4 range. I've sort of gone out to a 5 range just because on some days you can get some nice movements as well. So this is a 5 range chart, okay, and it's just so much easier because now your view, the way you're looking at the chart, it's based on price movement, right? Not movement of time. It's not like, okay, it's 12:55 and 43 seconds, so in 17 seconds I'm going to get a new bar forming. When you're looking at a range-based chart, it's if you're trading 8.5. Okay, well, if I trade 9, then a new bar is going to form. If I trade 9.5, I'm going to get a new bar. It's like that, right? So you're looking sort of at how bars are forming as price moves. So that's just going to give you a bit of insight that you probably would not see. Well, I'll say probably would not see. You're just not going to see on a time-based chart. And the exact same things that I'm looking at on I think I got E-mini chart here, right? If I'm looking at a normal E-mini chart during the day, same things that I'm looking at, right? Things that I talk about in my videos all the time. I'm also looking, whether it's a time-based chart, like an E-mini 1-minute chart, or a 10-year 5 range chart, 3 range chart, is the same things. Now, where it gets interesting, the thing that I really love to key in on 10 years is, remember, it is a market that trades a lot of volume. Okay, you see these bars, 42,000 contracts, 14,000 contracts, 13,000 contracts, 39,000 contracts. And what's the time between these bars, right? 8:20 to 8:38, so about 15 minutes, 40,000 contracts. 8:38 to 8:41, 3 minutes, 14,000 contracts. 7 minutes later, 13,000 contracts. About 15 minutes later, 40,000, 39.2, etc. So you're getting good volume. So what I love to key in on, and I sort of touched on this these last couple of days, is not just where the heavy volume is, right? Because again, that's what everybody's looking at in terms of book maps, depth of market, the domes, is I'm looking at those areas for lack of volume, areas where I don't see the normal order flow go through in a sense. And when I first released my software, someone asked me, I can't get this up on my NinjaTrader. Well, my software I use here is the software that I developed for my own trading. And over the years, people have asked me to, can they get a copy? So we started the Orderflows.com website where you can get the software. But exhaustion prints, you could look for this on your chart yourself. Okay, you don't need a software, right? You have eyes. I always say the best computer is the one on your shoulders, right? Your brain. And really all you're looking for is at the tops of, well, I'll say the tops, but the ends of moves. You're looking for lack of volume, exhaustion, okay? And it's going to make it easy. I'll just keep this at, let's keep it at, well, the default is 9, but I'll keep it at 10 because we used to call it single prints. So basically, we'd be looking for single prints at the edges of the bars. So basically, a volume of 10 or under in the bar, I want to be highlighted to it. Okay, here's a 5, here's a 9, here's a 6, right? Here's a 7. Just showing, going back a few days, right? As the market's moving down, 6, 4, 6, 2, 1. You don't see any exhaustion prints on the bottom of these bars. The market starts going up. Here's a 7. Here's a 5. Okay, and it's just something that, at a turning point in the market. Normally we're trading thousands of contracts, right? We're coming down here, 3,000, 2,800, here's 800, 800, 900, 2,500, 2,400, and then 7. Where's the interest, right? Well, if the last person sold or there's nobody interested in selling anymore, what do you think the market's going to do? So it's not going to go down, it's going to go back up, right? And we went back up to these new highs here, right? We had, again, this is sort of in an area that we've been trading around. Here it's quite a time difference from 1 until 2 in the afternoon, but here we're sort of going sideways. Okay, well, I got 6 here, so I know that the market came down from 11, trade all the way down to 05, back up to 09, trade 6. Okay, and then it just goes sideways, still holding, right? Trades 09, this time trade for several thousand, about close to 5,000 contracts. Then it came back down to 06, and again, this bar traded 14,000 contracts, but it only managed to trade 5 here. I'm looking for this market to trade back up, because now, right, we're trading, this bar closes at 8.5. Okay, I know at 9 we traded some size there. I'm thinking if we could get past this 9, can make a run back up higher. And then what happens? Boom, it gets past that 9, and it just keeps going up, 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 all the way up to here, right, to 13, where you trade 9 contracts. And then it reverses off of that. So it went from the 5 contracts up to the 9. As it's going up, it's trading a ton of contracts. 2,000, 2,000, 1,600, 3,700, 5,000, 5,000, 6,000, 2,000. Okay, then it works its way up, 2,800, 1,700, 9. What do you think? Market reverse. Now this bar is starting to trade. It goes all the way up to 13, trading back down at 11, 10.5. I know that this thing is just sticking out there. It's just telling me, Mike, nobody was interested in taking it higher at this moment. I mean, that doesn't mean that it can't go higher the rest of the day. Of course it can. But for now, based off the information that's available to the trading world, there's just no interest in taking it higher. And then it came right back down to 6.5. Right? How do you trade it? You just get short in here after this bar closes. 10, down to 9, down to 8, down to 7. Okay, now remember, 10 years trades in half ticks. Half tick is, full tick is 2 half ticks, which is 31.25. So what's half of that? I can't do the math. $16 or something like that. 1561.25. So again, if you're going to key on something, whether it's, if I'm looking at this on a 5 range chart, if I'm looking on a 3 range chart, I'd be looking for the same things. I'd be looking for those areas of lack of volume on the edges, right? The edges of the moves, okay? For areas where it's coming in, okay? It's a little bit different here on the 3 range, but I see a 2 here, right? On the edge of this move. There's a 9 here. That's that 9 from earlier, I believe. Here's your 5. Okay, you got a little bit in here, a 1 and a 3. But these are not at the edge of moves, right? This is the low. It goes up. Here you're sort of retesting this low from earlier. Then it goes up, you trade 9. And on the 3 range, it looks a little bit more bearish simply because you had that big aggressive buying coming in here with no follow through. Trades 9 right after big stacked buying imbalance. Okay. So again, and I know guys, that's all they look for, right? They trade these 10 years. The beauty of 10 years is you can move a ton of size. I'll say a ton of size. You can move good size, 20 contracts, 30 contracts, 50 contracts even, without affecting the market. And since you could move size and it's a liquid market, you don't have to be getting 20 ticks out of the move. You could just, I know guys, that's the whole strategy, is just to pull 4 or 5 ticks out of a move in the 10 years, just because they trade 50 contracts. So that's it. Anyway, guys, I hope you guys found this video useful. I apologize. I sort of started out kind of rocky on this video, but my point is, when you're looking at a market that just it doesn't move as the way ES moves, trying to look at a time-based chart isn't probably going to be in your best interest. Look at a range-based chart on slower moving markets, because you really want to take into account how the market is moving to take advantage of it. So thanks everyone. I'll catch you guys on the next video. Bye bye.